At 9:32 a.m., $1 trillion vanished from the global markets. No warning, no explanation, and for a few terrifying minutes, the world's financial system nearly collapsed. It started as a normal morning on Wall Street. Traders walked into offices, coffee machines hummed, stock tickers blinked across giant screens. But something strange was already happening. Trading algorithms across major exchanges were behaving differently. Orders were appearing, then disappearing. Prices moved slightly, then snapped back. One analyst later described it like this: "It felt like the market was hesitating, but nobody understood why, until 9:32 a.m., because that's when the first shock hit. And what happened next shocked everyone."
Without warning, major stocks began to drop. Fast. Within seconds, billions of dollars in market value disappeared from the Dow Jones Industrial Average. Then the panic spread. Trading algorithms triggered automatic sell orders, which triggered more sell orders, and suddenly the market was spiraling. Inside trading rooms, alarms started going off. One trader later recalled, "Everyone started shouting at once. Screens were flashing red everywhere." But this is where the mystery becomes disturbing, because analysts quickly realized something strange. The crash didn't start with human traders. It started with machines. Modern financial markets are controlled by algorithms, thousands of automated programs buying and selling stocks in milliseconds. Most of the time, they keep the market stable. But on that morning, something went wrong. Several major trading algorithms began reacting to the same signal, a signal that shouldn't have existed. And when they all reacted at once, they created a chain reaction. Within minutes, $800 billion disappeared from global markets. But investigators later discovered something even stranger. The signal that triggered the collapse came from a single trade.
Investigators traced the crash back to a massive sell order. It was placed by a trading firm in Chicago. The order was enormous, billions of dollars worth of futures contracts tied to the S&P 500. At first, regulators assumed it was a mistake, but when they contacted the firm, the response was chilling. "We didn't do anything unusual." And that's when investigators discovered something strange. The algorithm that placed the order was behaving exactly as it was programmed, meaning the crash wasn't caused by a bug. It was caused by something inside the market itself. As the crash accelerated, banks began noticing something terrifying. Transactions were failing. Transfers between major financial institutions were slowing down. Then some of them stopped completely. Inside one major bank, a risk manager reportedly said, "If liquidity disappears, we're in serious trouble." Because the global financial system depends on one thing above all else: trust. Banks lend billions to each other every day, but if that trust disappears, the system can freeze. And for a few terrifying minutes, that's exactly what almost happened. By now, the collapse was spreading across global markets. The Dow Jones Industrial Average plunged nearly 1,000 points in minutes. Some stocks briefly dropped to 1 cent. Others skyrocketed to impossible prices. A trader later described the moment. It was chaos. Prices weren't real anymore. But the most disturbing moment came seconds later, because suddenly, the market reversed. Violently. Stocks that had crashed instantly rebounded. Billions of dollars reappeared, almost as quickly as they vanished. And that's when investigators realized something terrifying. The global financial system had come within seconds of total failure. After the crisis stabilized, regulators launched a massive investigation. They analyzed millions of trades, thousands of algorithms. Months later, they released their conclusion. The crash happened because modern markets had become too fragile, too fast, too interconnected. High-frequency trading systems were interacting in ways no human could predict. One economist summarized the danger perfectly. The market isn't controlled by people anymore. It's controlled by machines reacting to machines. And that realization led to an unsettling question. What happens if the next shock is bigger?
Some analysts believe the crash revealed a hidden risk, a systemic cascade failure. In other words, a chain reaction where algorithms feed off each other until the system collapses. And once it starts, no one can stop it. But this is where the mystery becomes even more disturbing, because a few researchers noticed something strange in the trading data. The initial trade that triggered the crash was unusually precise, almost like someone knew exactly where the market was weakest. Some believe it was coincidence, others believe it was market manipulation, but no evidence was ever found, which leaves one unsettling possibility. The next crash might not be an accident. Today, global markets move trillions of dollars every day, almost all of it controlled by algorithms, faster than any human can understand. And economists quietly admit something unsettling. If the right combination of events happens, another collapse could happen again. Except next time, the market might not recover, because the system holding the global economy together is far more fragile than most people realize. And somewhere, right now, millions of trading algorithms are still running, waiting.